Revenue growth rate is the heartbeat of any business. It shows whether a company is expanding or stagnating. By comparing revenue from one period to the next, one can track how fast the business is growing. A high growth rate signals strong demand, effective sales strategies, or successful expansion into new markets. On the other hand, slow or negative growth can be a warning sign that competitors are gaining ground or that the market is shifting. Investors and stakeholders often look at the revenue growth first because it's a quick way to gauge momentum. For businesses, it is not just about making more sales. It is about sustaining that growth over time. Consistent revenue growth creates confidence and opens doors to reinvest in innovation, talent, and long-term projects. Net profit margin tells how much of every dollar earned actually becomes profit after all expenses are paid. It is the ultimate measure of a company's efficiency because it factors in everything: operating costs, taxes, and even interest. A healthy net profit margin means the business not only brings in revenue, but also manages costs wisely. In contrast, a low margin could indicate overspending, poor pricing strategies, or inefficiencies. This KPI is especially important for long-term survival, since profit is what keeps the lights on and fuels growth. Businesses with strong net profit margins can reinvest in new products, reward shareholders, or weather economic downturns. For those reading and analyzing financial statements, it's a reminder that although top-line revenue of a company might be impressive, the bottom-line profit might tell a different story. Gross profit margin zooms in on how much money a company makes after covering the direct cost of producing its goods or services. It answers the question, is the company making enough from its core operations? A strong margin generally indicates that products are priced effectively and production costs are well managed. If the margin is shrinking, it could point to rising material and production costs, for supplier negotiations, or pricing that does not reflect value. This KPI is especially vital for industries like retail and manufacturing, where controlling costs can make or break profitability. A business with a solid gross profit margin has the flexibility to invest in marketing, research, or customer service. This KPI is a foundation because if gross margins are weak, it is usually much harder to achieve a healthy net margin down the road. Churn rate measures the percentage of customers who stop using products or services of the company within a given period. It is one of the most critical KPIs, especially for businesses built on subscriptions or repeat purchases. A high churn rate often signals customer dissatisfaction, poor product market fit, or stronger competition, luring customers away. Reducing churn is often more profitable than acquiring new customers because retaining a loyal customer usually costs less than winning over a new one. Companies that excel in customer experience, product quality, and support often enjoy lower churn and higher loyalty. This KPI is also forward-looking because an increasing churn rate puts future revenue and growth at risk. In summary, a business can grow sales quickly, but without controlling its churn rate, it is like pouring water into a leaking bucket. Economic value added takes performance measurement to the next level by asking, is this business truly creating wealth or just generating accounting profit. Economic value added calculates the value the company produces after covering the cost of capital. In simple terms, it shows whether a business is earning more than it costs to fund its operations and investments. A positive economic value added means the company is generating real economic profit for shareholders. A negative economic value added suggests that the business is destroying value. This makes economic value added a favorite among investors and executives because it cuts through the noise of traditional accounting metrics. Unlike revenue or profit alone, economic value added factors in the cost of debt and equity, providing a more complete picture of financial health. It is a fascinating KPI because it highlights that not all profits are created equal. The true success comes from creating value above the cost of resources.